A lot of you appreciated my previous discussion on SoFi, and many requested an update regarding the company's current standing. After diving deep into their earnings and overall business model, I have to say, I'm seriously contemplating investing in SoFi myself. The more I analyze its operations, the more I'm drawn to its long-term potential. I see qualities in this company that remind me of my early investments in HIMS at various price points, and in many ways, SoFi's model appears even more promising. In this video, I'll break down SoFi's recent earnings, explore its business strategy, and share my overall perspective on why I believe this company has a strong future. Hello everyone, welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But before that, alert, this is not a financial advice video. Now let's address the stock's movement. Following the earnings report, SoFi stock saw a decline of approximately 4%. In my view, this drop is not justified. The company is actively expanding its footprint across various financial services, including home loans, student loans, personal loans, and investment options. Essentially, SoFi offers everything a customer may need financially, all within a single platform. This is what gives SoFi a unique edge over traditional banks, many of which suffer from outdated interfaces, clunky websites, and unnecessarily complex processes. SoFi simplifies banking, providing users with an intuitive, all-in-one solution. One of the reasons I see significant potential in SoFi is its ability to scale. Currently, only around 3% of the 262 million U.S. adult population utilizes SoFi for their financial needs. That means the company has approximately 10 million members, but there's room for exponential growth. If SoFi can capture 50 to 60 million users in the coming years, it would be a game changer. The company has already proven its ability to onboard and retain customers efficiently, with nearly 40% of new members adding a second product within the first month of joining. This cross-selling strategy is one of SoFi's greatest strengths. Once they acquire a customer through a single product, they can market additional financial services like home loans, student loans, and credit cards without incurring additional advertising expenses. This model allows them to maximize profitability over time. SoFi's approach is somewhat similar to other businesses that thrive on cross-selling, but it has an advantage over companies like HIMS. With HIMS, a customer may only need prescriptions for a limited period before discontinuing the service. However, financial needs are lifelong. A person will always need banking, lending, or investment solutions, making SoFi a more sustainable long-term business. Their ability to provide continuous financial services makes their model incredibly robust. The company's leadership also shares this vision. According to SoFi's CEO, the opportunity for expansion remains vast, and it feels like the early days of their journey. Despite already having over 10.1 million members, which reflects a 34% year-over-year increase, there's still substantial room for growth. With thousands of financial products available for cross-selling, revenue continues to rise, and their adjusted EBITDA is expanding. Notably, 2023 marked their first full year of profitability, with a net income margin exceeding 9%. This trend is expected to continue improving as the company scales further. SoFi is currently prioritizing growth over maximizing net income margins. Their focus is on brand establishment, customer acquisition, and expanding their ecosystem. Once they reach a critical mass, potentially 50 to 70 million users, they can then shift their attention toward enhancing profitability and optimizing their margins. They are also emphasizing financial services in their tech platform, since these areas offer high-margin, fee-based revenue streams. Currently, these segments contribute to nearly 47% of total revenue, and this percentage is expected to increase over time. Now let's discuss their lending platform. When someone applies for a loan through SoFi, the company has two primary options. First, they can retain the loan on their balance sheet and collect interest, assuming the loan meets their risk criteria. Alternatively, for higher-risk loans, SoFi can refer borrowers to third-party banks while still managing the loan servicing. This means they collect origination fees and servicing fees without taking on the financial risk associated with defaults. This setup allows them to generate substantial revenue while maintaining a low-risk profile. SoFi also owns Galileo, a financial technology platform that provides infrastructure for banks and fintech companies. Many industry experts compare Galileo to Amazon Web Services in the financial sector, as it enables institutions to create, launch, and manage financial products efficiently. While its growth rate of 15% isn't the fastest, it remains highly profitable and continues to expand its market presence. The company is positioning itself as a leader in both direct-to-consumer finance and B2B fintech solutions. One key strength of SoFi is the quality of its borrowers. Their average personal loan customer earns around $158,000 annually, with an average FICO score of 744. This indicates that they are catering to a financially stable demographic, which reduces the risk of defaults and enhances their lending portfolio's overall quality. So why did the stock drop after earnings? The main reason was guidance. SoFi projected an earnings per share (EPS) range of 25 cents to 27 cents for 2025, while analysts were expecting at least 28 cents. This minor discrepancy led to short-term market pessimism. However, the company is allocating more resources toward research, development, and marketing, actions that will drive long-term growth. It's important to recognize that SoFi's management tends to be conservative with projections. Historically, they have consistently exceeded initial guidance, as evidenced by their 2024 earnings estimates, which started at 7 to 8 cents and ultimately reached 15 per share. Given this track record, it wouldn't be surprising if they once again outperform expectations. From a valuation standpoint, SoFi currently trades at a forward PE ratio of 63. While this may seem high, it's crucial to consider the company's projected earnings growth. EPS is expected to rise by 65% in 2025, 86% in 2026, and 35% in 2027. When evaluating growth stocks, the price-to-earnings growth (P/E ratio) is a key metric, and SoFi is still trading below a 1 PEG ratio, indicating that it remains fairly valued relative to its growth potential. By 2026, SoFi's GAAP earnings are expected to range between 55 and 80 cents per share, with annual growth projections of 20 to 25% beyond that. Using conservative valuation models, a PE ratio of 30, which accounts for significant multiple compression, would result in a stock price between $28.50 and $46.80 by 2029, representing an upside of 81% to 198% over the next 5 years. In conclusion, while SoFi may appear expensive in the short term, its business model, scalability, and cross-selling potential make it a compelling long-term investment. The company is prioritizing growth now, which should pay off substantially in the future. Given its solid financials, growing user base, and consistent earnings surprises, SoFi presents an attractive opportunity for investors willing to think beyond immediate price fluctuations. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.